Alrighty, so this is part 2 on how to make your first $10,000 with the highly profitable put ratio spread. Now, if you haven't watched part 1 yet, please go ahead and watch that first. I'll put the link in the description below and also at the top right hand corner of this video. Alright, so for this part 2 of the video, the next thing I want to talk about is how you can reach the potential of the max profit of the put ratio spread, right? So if you take a look at this spreadsheet down here, you can see that there are a number of trades which I have profited over $1,000 when, you know, the large majority of it is only $200 over dollars, right? So you can see there's one or two trades down here, there's over $1,000. Here another one, 1,100, and then you have a pretty big one down here, 1,900 and $1,515. So in order for you to really try and reach the max profit, to potentially hit the max profit for the put ratio spread, you need to hold it all the way to expiration. And the reason for this is because the put ratio spread is a very slow moving spread. So what do I mean by a slow spread? A slow spread is one whereby it takes a long time for it to reach the max profit, right? So unlike a short put, if you were just to go for a short put can reach its max profit pretty quickly, right? Especially when the market goes up, right? But because the put ratio spread has an embedded long put spread, there is a little bit more difference. It's slightly more different than the short put because of this zone, right? So as you can see, this is the risk profile where it's 14 days to expiration. So I put on this spread. So this spread initially started when there's around 45 days to expiration, right? So you can see that many days have actually passed. In fact, 31 days has passed, but then there is still not much movement in this profit zone. You can see that this profit zone down here has not even really reached anywhere close this green line at expiration, right? So this green line is the profit that you will stand to make at expiration. So you have put on this spread for 31 days, but then even though if Mr. Market actually has gone down all the way to your profit zone and he has stayed there, guess what? You're not making any money. In fact, if he went to this point down here, where at expiration you would be at a profit, let's say at this line down here, you would be at a profit, but the problem is that at 14 days, it is a loss, right? You can see this is a loss at 14 days to expiration. So generally when it comes to naked options, right, like short put, short calls, or even the strangle, you generally want to get out at 21 days to expiration. And I mentioned this a few times in a few videos in the past, and that is actually true because those are basically naked options. There are no long put options or long options inside it, right? So in those cases, the gamma will pick up very quickly and you can stand to actually lose quite a bit of money as it gets closer to the expiration date, as the gamma picks up, because you become much more exposed to direction. But when it comes to the put ratio spread, it's slightly different because you have this embedded long put spread, and the only way that you can actually achieve this max profit is if you hold it to expiration. If you were to hold it just to 21 days to expiration or even 14 days to expiration, as you can see, there's just 14 days left to expiration. There's not much that you can make down here. So if you're going to hold the trade, right, if you're going to put on the put ratio spread and we just want to get out around 21 days to expiration, then it's better not to put on the put ratio spread at all. It's better that you just go with the simple short put trade, right, instead of this put ratio spread. If you want to put this put ratio spread, you need to bring it all the way to expiration. So you can see this is when there's 7 days to expiration. As you can see, there's 7 days left. You put it on for almost 40 days and it's still nowhere near the max profit. You can see the max profit down here, even though if Mr. Market goes down here, you're still not making much, right? And then this is where it's 1 day to expiration. You can see 1 day to expiration, basically it's around 50%, slightly above 50% of the maximum profit. So in just 1 day, right, if you were to hit this, or if the market was to stay within this zone from here to here, you can see that in 1 day you can stand to make much more, right? So the premium, or rather the amount which you stand to make in just 1 day, is pretty much the kind of premium that you took, right, to make in the 45 days, or rather 44 days, right? So what I'm trying to say is that imagine if you held the trade for 44 days, right? If you hold the trade to 44 days and Mr. Market just so happens to be in the middle of this profit zone, well, you only made 50%. Should you get out or should you just stay? Now, there are arguments for both sides, but since you've already hold it to 44 days to achieve 50% of the max profit, you can actually get the second half of the max profit in just one day. So as you can see, there is a huge difference in the kind of profit that you can make from the number of days when you first started all the way to the end. So of course, during that one day, the market could just spike down, or just spike up out of the profit zone. There's always the possibility. But then again, this is how the trade is being done, right? You put on this trade from the beginning, you want to hold it all the way to expiration and see where it goes. And again, it is all a probability game. So that is why for the put ratio spread, if I am not planning to get long stock, right? If I'm not using it to enter into a long stock position, if I'm just trading it, then I will hold it all the way to expiration. Now, if you were to hold it all the way to expiration, another issue will arise. The issue would be that what if Mr. Market, right, he goes all the way past your short strike. All right, let's not say go past your short strike by that much. Let's just say that he goes all the way to just slightly under your short put strike. All right, this is where you have your two short puts down here. So what happens is that when there is 1 day left to expiration, or even anything less than 21 days, there's always a possibility of you to get assigned, right? If you're going to get assigned on your short put, what's going to happen is that suddenly you're going to be long 200 shares down here, right? 200 shares, and 200 shares of this price down here, that is $18,000, $250 per 100 shares. So you need double of that, right? So there's about $36,000, $37,000. This is where the problem is going to come, right? Because you enter this trade without the expectation that you're going to buy the shares, right? Now, of course, you can simply just sell off the shares and then put on the short put again, but then it becomes very troublesome, it becomes very messy. A lot of people get confused by this. If one side gets assigned, the other one doesn't get assigned, what do I do? And all that stuff we want to avoid. So the only way you can avoid this is by trading European style options, right? So in case you're not familiar, there are two types of option style. They have the American style, American style, and then you have the European style options, right? So for the American style options, basically the buyer of the option can exercise the option at any time before expiration. So they could buy it today and then they decide to exercise it tomorrow. So in that case, because you are the seller of the option, you have the obligation to take on the other side, right? So in a put option, your obligation is to buy the shares, right? So if he was to exercise this, you have no choice. You will be assigned the shares and you need to have the money to put up for the shares, otherwise you will have margin call. Now, what about the European options? So the European options in this case is that there is no early assignment. In fact, the only time it can only be exercised is only at expiration. So that is why you only want to put on the put ratio spread on European style options. So this way, even though the market is all the way past your short strike before expiration, there's no chance for your options to get exercised. So you do not have to worry about being assigned. So when it comes to trading the put ratio spread, you want to trade what I call these European style options that are cash settled. So at the moment right now, there are basically 5 of them that I know of. You have the MRAT, which is basically the mini Russell 2000 index, which is the example which I showed you down here. The MRAT, this is the mini Russell 2000 index options. So basically it's the mini version of the RAT, right? So the RAT is the full size version, which is much heavier in terms of capital. And then you have the XSP, which is the mini SPX index options. And then you have the NASDAQ, which is the NASDAQ index options, right? So basically all these 5 are European style options and there's absolutely no risk of early assignment, and this is cash settled, which means to say that there is no assignment of shares, right? You won't be able to get shares at all. So once it reaches expiration, it all comes down to where the market is at expiration, okay? So if the market is at this point down here at expiration, then it's just going to expire worthless because you already received the credit at the start, right? Now, if Mr. Market is going to expire at this point, right, at expiration, basically then your max profit will be at this point. So what will happen is that the shortfall in this profit will be then credited into your account. Now, likewise, if you're in a loss, let's say for example, Mr. Market is down here at expiration, then you're going to suffer a loss. Basically, this amount will be debited from your account. So again, there's no assignment of shares, so you don't have to worry about that and don't have to worry about early assignment. All right, so now let's talk a little bit about a put spread, the put ratio spread construction, basically how you want to put it up. So basically, you want to put it up at around 45 to 60 days to expiration. All right, I explained this many times before. To me, this is the optimal place where you want to put it, where it is just nice, a distance away from where the market is, as well as you can have a nice size for your tent, right? Your profit zone can be a nice size, as well as what's most important is that the expected move, right? The implied volatility is more than the actual volatility when the options are 45 days and above, right? This is where implied volatility is greater than historical volatility. Anything less than that, then it has been shown that the statistics is that the implied volatility tends to be lesser, right? So what this means is that basically if you stick to this days to expiration for your option, you have a higher probability than what it states down here, all right? Okay, so the next is that the short put strike is at the expected move, as I mentioned. So expected move is usually around 15 deltas to 20 deltas. And then the long put spread, strikes, it depends on your view, right? If you're more bullish, you can have a smaller width with smaller debit, which I shared with you earlier on. And then if you're more bearish, you can build a larger tent, right? A larger catchment area, and this will give you a bigger debit. That means it's more expensive for you to buy the long put spread, which results in a smaller overall credit for your put ratio spread. So you have a wider, larger profit zone. That means you shift your long put spread to closer at the market. All right, if you can remember, it looks something like this. So your long put spread is closer to where the current market price is. And then if you want to go for narrow but higher profit potential, you can have a out the money long strike, which would go something like this, right? So this is not as near to the market as possible, but you still have a decently wide profit range. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Okay, so how often and when do you enter into a put ratio spread? So first of all, there are 2 ways. The first way is to enter the put ratio spread one at a time. All right, so if you're just new to put ratio spread and you want to get your feet wet, then this is the way that I suggest you do it first, right? So basically you put on a put ratio spread one at a time. So let's say for example the price is now and you've decided to put on the put ratio spread. So the put ratio spread would be something like this. So once you put on the put ratio spread, basically you wait all the way to expiration. Once it expires, then you put on another trade again. Right, so this is very good if you're just starting out, so you understand the dynamics of the put ratio spread and to just get a little bit of a feeling first before you start to put on even more put ratio spread. And for this, you want to be quite selective, right? So basically what you want to do is you want to look at a few things on the chart. So first of all, as I mentioned in many of my previous videos, you want to take a look at support areas, right? Those significant support areas. And then also you might want to consider looking at the stochastics, right? So stochastics indicator is basically where it monitors the market's condition, whether it's overbought or oversold. So let's say for example, if the stochastics is showing that it's almost, right in the oversold region or almost at the oversold region somewhere around here, right? What you could do is you want to place the put ratio spread, right? So what you want to do is you want to see whether the expected move is below a support area. So let's say for example at this point in time, you see that there's a support area here, and then you take a look at the expected move. If the expected move shows that the strike is going to be somewhere at 390, right, at this point at 390, that means your put ratio spread might look something like this, right? So this is where the short strike is, and then like that. This is where the cutoff point is, and then past this point, right, somewhere down here, this is where you'll start to lose money. Right, let me just draw the line down here. So somewhere down here, you'll start to lose money. Okay, so at this point of time, you might want to ask yourself whether this is the place where you want to put the put ratio spread, because remember, you only have one put ratio spread to put at a time. Whether win or loss comes down to where it settles at expiration. So if there's a support here, there's a chance that the market, right, might come down and then bounce up somewhere down here. Now, if you feel that this put ratio spread, or rather where the strike is a little bit too high up, you might want to wait for the market to go down. So let me just draw this support area again. So let's say, for example, you want to place the short strike of the put ratio spread below this support area. So in this case, if you notice that the expected move shows that you can only place the short strike at 390, then you want to wait for the market to go a little bit further down first, right? So once it goes a little bit further down, you take a look at the expected move again, and if you see that the short strikes can be at 370, then this is where you want to enter into your put ratio spread, because your put ratio spread would probably look something like this, right? So this is where your tent is. Remember, the short put strikes is where the height or the maximum potential profit can be gained. Now, as you get a little bit more experience, or you have a little bit more capital, you want to start to put on more put ratio spreads, right? So for example, let's say you have a larger account size and you're able to put on 2 put ratio spread at a time, right? Let's say you can put 2 put ratio spread at a time based on your buying power and the risk that you've allocated per trade. So instead of just putting 2 put ratios at the same place, right? Let's say, for example, you have 1 put ratio spread down here. All right, a put ratio spread, let's say you can put 2 put ratio spread down here. Instead of doing this, what you want to do is you want to spread out your put ratio spread, right? Instead of putting 2, you want to only put 1. Then maybe as the market moves, either it goes up or it goes down. Let's say, for example, it goes up or down again. Then you can choose to put another put ratio spread. So maybe you might want to put it somewhere around here. So what this does is that you're diversifying your put ratio spread in terms of different price, different day and time, and also different days to expiration. So this way, you're kind of like evening out your P&L, right? Your P&L variance will be much lesser than if you were to put all at just one place, right? So this is the approach that I want to take. So as you get more experience and you have more buying power, you want to place your put ratio spread at different places. So for me, this is the method that I actually use, which you have seen in the spreadsheet in my previous video. So basically what I did is I would place the put ratio spread at different points, right? So I will put a put ratio spread when the price maybe drops down a little bit, right? I'll put one here. If it goes up again, I'll put another one down here. As it goes down again, I'll put another one down here. So this way, I have many different catchment areas. So this way, I have many different chances of trying to hit that max profit, rather than just to single down to just one area to hit the max profit, which is a little bit of a hit and miss, right? So the next thing is that when I put on this put ratio spread, I put on different strikes for the long put spread, right? As you have seen in the previous slides, you have seen that there are many different types of put ratio spread. Okay, so for example, the first put ratio spread that I put on might be the traditional put ratio spread that looks something like this, right? So where basically the short strikes are all at the same point. And then the second one, I may enter one where the long put spread, I change the strikes a little bit. So it looks probably something like this, where it's much closer to at the market, right? So where the long put spread is down here, and then the short strike where this expected move is over here. So it looks something like this. And for the next one, I may want one that the catchment area is really very big. That means I have a really huge tent, but then I forego a lot of the credit up front. So I may have the third one that goes something like this. So this way, I have a chance of catching this big potential profit area if the market does settle here at expiration. So this way, I'm really diversifying on all different fronts, right? I have different prices, different strikes, different timing which I enter, different days, and also at using different types of put ratio spread. Okay, so when do you enter into a put ratio spread? So generally, when I enter into a put ratio spread, I want to enter it on a down day, right? So you can see these candlesticks when it's down, right? So Obviously, I do not enter every time there is a down day. Basically, I will just choose at different prices, and again, this is up to your own discretion and your view of the market. But basically, what you want to do when you're entering into a put ratio spread is when the market is going down, right? So the reason is because most of the time, right, not all of the time, but most of the time when the market is going down, the IV is increased, right? When you have an increased IV, you're going to have a put ratio spread where the tent can be much higher, right? Where you have this higher max profit potential, right? So this is exactly what we want to get when we are placing on the put ratio spread. At the same time, we will get more premium and you're able to get a better break-even point compared to if you were to enter on an up day. So generally on an up day, most of the time, the IV will actually drop. So when the IV drop, you're not going to be able to build a put ratio spread that has a higher max profit potential compared to when the IV is increased. So maybe when the IV is lower, the put ratio spread that you can craft maybe would be something like this, where the maximum profit is going to be much lower, right? If it's going to be much lower, you're not going to be making much more, and especially your break-even point will be closer to the market. And this is where your risk can really increase, because as you know, when the market crashes, and especially if your break-even point is much closer to the market, then you're not going to have a big enough catchment area in case the market really goes all the way down, right? So that is why I prefer to enter into a put ratio spread when the market is going down. Next, we're going to be talking about a very important point, and that is capital allocation. So this is very important, because if you do the wrong capital allocation, and even though you have a good strategy on, you could actually lose your whole account. Remember, this is an undefined risk. That means there is the potential for you to lose a lot of money. As you can see in this order ticket here, it says the max loss is so much, all right, 17,000 plus, but you're not going to reach that. Okay, so let me just explain to you ideally what you want to do. So first of all, you do not want to risk more than 1% to 5% per put ratio spread. All right, so ideally this is the max you want to go. If you have a smaller account, then you have no choice but to really only reach up to 5%, or in some cases maybe even 10%, right? That's really the max you want to go. So since this is an undefined risk trade, how do you identify what the risk is? How do you calculate this 1 to 5%? Well, the answer is through the buying power reduction, or what is called the buying power effect, right? So this buying power effect is basically the margin, the cash that you have to put up to put on this position. Right, so this is the amount that's calculated by your broker based on what they think, based on their calculation, that is the risk, the likely max risk that can happen when you put on this trade. So this is actually equal to 2 standard deviations, right? So if you can see this order ticket down here, it says the max loss is $17,440. Well, this is the potential max loss. So potentially, could you reach this? Yes. Possibly, yes, but probability-wise, it's very highly unlikely, right? Because remember, you have a time frame, right? The time frame is around 45 to 60 days. The chances of it going to zero, right? You only lose this max amount if it goes to zero in the next 45 to 60 days. If it really does, then I think we have much more to worry about than this amount down here, because the economy probably has just collapsed, right? If you are talking about index ETF, right? Market index ETFs. So this is how you want to calculate your risk. So as you can see, this is for the MRAT. For the MRAT, for one put ratio spread, the buying power effect is already 2,000 plus, which means to say the account size which you want to have on is roughly around 40 to around 50K. If you want to have around a 5% allocation, but you know, you can probably push it to have a 10% allocation, you know, by $25,000 account, right? But just remember that the more you risk, the more amount that you can potentially lose as well whenever you hit the loser. So this is very important to understand. As you can see, the XSP is even bigger. So this is where you probably need a 6 figures account, probably at least $100,000. So the whole idea down here is that you want to put on small position sizes each time. So the larger account, you can always put on like 1%, but if your account it's not that big, you can go by 5%, but the most you want to have is up to 10 maximum trades of 5%, because the rule down here is that you do not want to go past the 50% capital allocation mark, right? So let's say if you have a let's say if you have a $50,000 account, so the most you want to allocate your capital on any of the trades down here, let's say would be only up to $25,000, and you want to keep the other $25,000 free because firstly, your buying power effect can increase as the market crashes, right? In the volatility increases, your buying power will increase. So when you put on, you may think that the volatility, or rather the buying power effect, is only about $2,400. But as the market crashes, this $2,400 will start to increase. Maybe it increases to $2,800 or maybe even to $3,000. So that is why you need to have enough capital to help to supplement this increase in the buying power effect in case, right, it does increase, especially during volatile times. The other thing is that you want to keep some spare bullet as well so that you can fight back in case you have some losses, right? So never want to risk so much in one trade all at one go. So this is very important, especially if you want to put on trades like the put ratio spread, which is an undefined risk trade. All right, guys, so let's go to some takeaways. So first of all, the put ratio spread is a neutral to bullish strategy that has a very high probability, 80% probability of profit if you put the short strike at the expected move number. And then the put ratio spread consists of a short put, and then you have the embedded long put spread. So it's a very flexible, right, kind of strategy, and you can manipulate the long put spread to suit your view of the market. Next is that it's a very slow spread as mentioned, so that is why you want to hold it all the way to expiration so that you can potentially reach the max profit. And that is why if we are going to hold to expiration, we only want to trade on the index ETFs that has European style options that you do not have any early assignment, and that is these 5 index options at the moment. And finally, you do not want to risk more than 1 to 5% per trade, and you measure the risk using the buying power reduction or the buying power effect. Alright guys, so that's it for this video. I hope you found this video really helpful and give you some idea to put on the put ratio spread for yourself. And if it has, I appreciate if you give me a thumbs up and also subscribe to my channel as well. And as always, thank you for watching. I appreciate your time and may the options favor you.